There's so many places where you can apply AI and agentic, and you could say, I can see opportunities here and I can see opportunities there, and it could be in my front office, in my back office, in commercial lending, in digital marketing. Focus. What are the 2 or 3 areas, at least out of the gate, that can provide disproportionate value?
That's McKinsey senior partner Ido Segev. He's talking about the first steps that banks should take to integrate AI across all their operations. He joins us to explore how AI is already transforming banking at every level, from profits to customer relationships to competition. McKinsey's research and today's headlines point to lots of experimentation happening in banks. But what really works? Let's find out. This is the McKinsey podcast, where we help you make sense out of the world's toughest business challenges. I'm Roberta Fusaro, your host for today. Ido, it's good to see you.
Yeah, it's good to see you, Roberta, and thanks for having me.
Every year, McKinsey releases its global banking annual review. And I guess to no one's surprise at all, one of the biggest themes this year is artificial intelligence, AI, and its impact on banking. Ido, what are you telling clients about the speed at which AI is emerging?
It's important to pursue it, but while they are going after it tactically, strategically, I think the questions that they're asking is, one, how quickly is it coming? 2, what is the potential impact? How much value would it deliver to my own P&L? But also, how is it going to impact potentially the industry overall? How our revenue distribution, profit distribution might be impacted? I think the third strategic question that they are asking is, what does it mean for us? How quickly should we actually pursue this? A lot of them are experimenting, but should they move more quickly? Should they scale things more quickly, or should they sit on the sidelines and wait to see how it matures?
What are the considerations for those banks that are starting to adopt AI?
I think there are a couple of considerations. The first is how quickly the technology is actually maturing, and it's maturing and evolving at rapid pace, right? So if you just compare, for example, the different LLMs, ChatGPT and Gemini and Anthropic, and you see how they keep surpassing each other, and every 6 months and now 3 months a new version comes out and it's smarter and more intelligent. I think the second driver of adoption and pace is how quickly will customers actually trust AI to delegate to the agents tasks that they would normally do. So I think we see a lot of customers already going to agents and asking for advice. But at what point will customers actually allow agents to move money from one account to another? At what point would customers basically ask AI to apply for a credit card on their behalf because they found a great opportunity? And the third driver of adoption is, how quickly can a bank actually deploy AI at scale across at least the relevant parts of the organization? And by that, I mean actually deploying AI where agents are becoming like virtual employees, where the ratio of employee to agent goes from 20 virtual employees to 1 employee, right? And then above all that, particularly in this industry that we're in, banking, the regulator and how the regulator stance is going to evolve towards AI, And what we see there is that the regulator is obviously more conservative when it comes to how banks are making credit choices, like who to lend and who to not lend at what price. But when it comes to how the bank runs the operation, say call center, for example, there's less regulatory risk associated with that.
So, Ido, you mentioned this idea, one of the adoption factors being customers and trust. So what can banks do to start to build or change that relationship with customers and build that level of trust to get us to that place where they're willing to have agents do their banking for them?
Consumers are going to be a bit more hesitant to now maybe share more information or let agents take actions on their behalf if there isn't a clear value proposition. A clear value proposition could be, I can do things much, much faster. I can do things much more cheaply, or I can actually get better rates. You take examples from the digital age. People were talking about privacy and sharing location information. Well, guess what? Everybody is using now navigation apps, and those navigation apps know at every second where exactly I am, but people don't mind using that because they get value.
Which freaks me out entirely.
I know it fixes it, but there's value in the exchange, right? So to accelerate adoption, the question is, what can the bank do in order to provide more value than the customer will get otherwise? I think the reality is that the trust is probably going to be driven first by attackers like challengers, fintechs, who will provide those solutions that add value at the same time with banks, or maybe even before, right? So you can imagine how a non-bank fintech could come in and say, hey, Roberta, I can optimize your deposits. You probably have a lot of deposits that sit at low interest rate. And I have an agent that would look at that. And not only will tell you, Roberta, you should move your money from bank X to bank Y because, bank Y has better rates, but could also move the money for you. And you know what? We could do that daily or weekly or monthly on your behalf. And you would say, hey, I can see the value of that. If I did that and if I optimized, let me give it a try. And so it's a real use case that could have meaningful impact on overall banking revenue pools. And this is something that could happen tomorrow. And it's likely that there will be a few early adopters that will get excited by this use case and would use it. And then banks would have to say, oh my God, I need to do something about that because I don't want to lose that money. I don't want to lose that customer.
Okay, that's on the customer side. You had also talked about one of the factors toward greater adoption being banks using AI at scale. And there's lots of research about how a lot of AI pilots get stuck in purgatory and people can't quite figure out how to move them beyond a particular group or a particular use case. What do you think needs to happen for banks to solve this AI at scale problem?
The first is actually focus. Okay. There's so many places where you can apply AI and agentic, and you could say, I can see opportunities here and I can see opportunities there, and it could be in my front office, in my back office, in commercial lending, in digital marketing. Focus. What are the 2 or 3 areas, at least out of the gate, that can provide disproportionate value? I would add to that, you think about places where agentic and AI can help you take down your cost, but also help you accelerate revenue growth. Why is that important? Because I think creating the perception that the AI is all about cost drives fear in the organization and stagnation. And if you can straight out of the gate say, look, this is something that could allow us to be more efficient, more productive, but also accelerate our growth. Now that provides a platform for further acceleration or scale up. The second is, it's not a technology thing. This is a one team, one goal. It's business and technology. And by the way, HR, a big contributor here in terms of virtual employees and real employees, and how do they work together, and how do you performance manage? It's a big thing. How do you upskill, which is the next thing. You need to upskill the organization while you drive the transformation. Regardless of seniority, there are people who are already like early adopters and they vibe code at home, and there are people who are like, I'm not sure. Everybody needs to be upskilled. The fourth, and this is an important one, is running a proof of value and releasing capacity. So for example, you redesign a process, say in your call center, and you made your reps more productive, does not equate immediately to capturing value. Capacity is not value, right? What happens right now with that capacity is that the dogs are the ones who benefit the most from it because their owners have more time to take them out for walks. I hear that a lot from my clients, and it makes sense because you need to have a plan to monetize that capacity. And you monetize that capacity in 2 ways. You either put it to work to drive higher productivity, or you take it out. And so I think from the outset, making sure that you set up a redesign of a domain or a workflow, and you say, look, I'm going to generate this much capacity, and here's what I'm going to do with it.
Mm-hmm. Mm-hmm.
Small but very meaningful step. I think safety and governance, right, particularly in a regulated industry, how do you make sure that you stay within guardrails and within what you are comfortable with as an organization? It's actually something that accelerates pace. They say the reason why Formula One's car can drive very, very quickly is because they have amazing brakes. And so that's the mindset, like have the braking system to allow you to accelerate. And then the final one I would say is data and metadata and contextual data as a multiplier is like something that only you can do, right? That would make your agents, your being bank X or bank Y, smarter, more skillful than other agents that you can quote unquote buy off the street.
This point of differentiation, it seems to be at the core of a lot of this. Even with your interactions with customers, you want to have a strong value proposition and give them something that they can't get now or can't get from someone else, right? The way that you bring it.
Yeah, exactly. And therefore, the data and the history that you have with your customer, how do you leverage that? How do you actually put it to work to make every interaction much more valuable?
Is adopting AI harder for a particular cohort of banks than for others? Or do all these challenges apply equally across the board?
I think there's a question of who stands to win, right? Is it just like the large banks with the big pockets who are going to win? Or could there be, super regional, mid caps, community bank that could be winners in their categories as well? I think this question particularly is relevant to a market like the United States where we have so many banks. And at least in our analysis that we published in our Global Banking Annual Report, we looked at that, and our view is that in each of those categories, there could be like a set of like winners, not many, but there could be winners. So in the global bank, the GSIBs, there could be one or two, maybe three like big winners. In super regionals, like, maybe five, six. In regionals, 10, 15. And those winners, are the ones who will adopt this faster, will overcome the scale issues that we just talked about, will start seeing impact on their bottom line, will use that impact, that profit, extra profitability to reinvest in growth and ultimately capture share from the laggards.
Ido, so when we talk about these winners, talk a little bit about maybe how their approach is different from some other competitors.
Yeah, so I think it's about this time last year that agentic became a more real thing. And I say that because we're still in early innings here. There isn't one bank or a few banks that we could say, hey, they figured it out and they are now running at full speed. Even some of the banks that we hear about in the news about stuff that they did, there's still ways to go. But if I just double down on some of the things that they do and some of the impact that they are seeing. So there is a bank that we work with where they have been on the journey to deploy agentic in their call center. And what they do in the call center, as an example, is provide like an AI assistant to our customer call center reps that provides input about the caller and that provide like recommended answers, all in an attempt to reduce the average handle time, right, which is a critical factor. And we saw in some situation, calls that the average handle time can go down from 4 or 5 minutes to about a minute. That's a meaningful reduction. In call center, we see how companies are now saying, hey, there are certain types of calls that are actually better handled or can be handled effectively by an agentic voice. And that's meaningful impact. So that's one set that we see with clients. Another area is in the operational risk, KYC, know your customer. That's an area of the bank that they spend a lot of people and a lot of money. And we see banks basically saying, how can we make the process much more productive, much more efficient so we can run it with maybe 60% of the people, 70% of the people that do it, maybe even 50% of the people that do it right now. And we see banks, rethinking their workflows and where they apply the AI and where do we still want to keep the human in the loop? Because I don't think that anybody believes that we're in a place where we can do it entirely without people. And what will be the role of the human in the loop? The third one that I would say is in the front office, in sales, right? So imagine like a banker basically going after potential opportunities with new clients. The AI can integrate all the information about that potential client. What is the latest about them? What could be their needs? Can synthesize other interaction that we've had from the side and create a brief for you. Look, Roberta, as you go, we speak with ACME, here's what you need to do. And then even beyond that, if you knew a CFO of ACME, company is, I don't know, like a very outgoing person, you can create like a AI simulator that will allow you to simulate the conversation with that person. And then when you go to the actual conversation, you have already role played it, so you feel more confident about that.
So the role playing, I hadn't even thought of that as a potential application. I love that, Ido. I'm going to build my own agent so that I can practice for the podcast against various personality types.
I had like an agent role playing you to prepare for this podcast.
I love it. I love it. I hope that I was kind to you. A question for you though, Ido. As companies begin to deploy AI, they're using it to improve the customer experience or to boost productivity. What kinds of cost factors do they need to think about? And what did the report show in that regard?
In our report, we actually planned out a few scenarios, right? Based on the level of customer adoption and the end level of bank adoption. It's conceptual, but we had a 2x2 matrix where one axis was customer adoption, and on the lower on that axis, we had customers that are using it just for advice. And at the other end of that axis, the sole access point to a bank is agentic. So no branches, no call center, no mobile app, right? So it's a bit extreme, right? And then on the x-axis, we had bank adoption as on the one end, hey, this is just a copilot. And on the other axis, just to be completely extreme, it was zero touch, hardly any humans. Okay. And then we actually talked as part of our report with about 50 or 60 banking CEOs globally, and with investors and with academics, people who research the space, and with fintechs. And we tried to say, okay, what is the most likely scenario? And the most likely scenario was one where, customer adoption goes beyond just the advice. Customers are increasingly getting comfortable with agents actually making some actions on their behalf, but it doesn't fully replace all other channels. And from a bank adoption standpoint, I think we got to a place where people, through those conversations and our insight, this is going to be 20, 30 agents per bank employee. And I think it's important because then it's under that scenario that you understand, the potential impact. And under this scenario, if you then play it out, you say, hey, we're talking about, say, 25% reduction in bank overall cost. Okay. By the way, that's also accounting for an increase of IT spend, right? And, a lot of that cost benefit is coming from middle office, from operation and back office. Some of that impact comes from front office, making our salespeople more productive, making our marketing more productive. Okay. Let's translate that to dollar terms. At least our math suggested that 25% cost improvement translates to about $250 to $500 million for every 100 billion assets. So if you have 100 billion assets, the impact to the bottom line is 150 to 500. If you're 200 billion, it's 500 to a billion, to the bottom line. So it's quite substantive. So that's the impact on the cost and therefore the incremental profit. We do expect, and we looked at the report as well, is that increased profitability will be competed out and will be transferred back to the customers. Right? Just natural competition, attackers come in, price lower, there's pricing compression, and all that margin basically goes away to the customer. That's what we saw also in the digital transformation age, right? Where banks have developed digital apps and more consumers, and actually not just consumers, use digital apps. Banks are not massively more profitable now than they were 20 years ago, right? So it's going to be competed out. And the last thing I would say just about the dynamics is why urgency matters. Because if you are able to be ahead of that and get that 250 to 500 million of extra profitability per 100 billion of assets early, you are going to be ready for the time that pricing starts to compress and that profit starts moving, and you'll be able to reinvest in now capturing share from the ones who are not ready.
So you're always staying one step or two steps or 500 million steps ahead.
Exactly. And I think it's particularly important because If you add on top of that the fact that down the road, when those models that I talked about, agents optimizing your deposits or agent optimizing your credit card loans, that means that overall profit for the industry might actually shrink. And by the way, we looked at the report and we estimated overall profit pools to compress by 9 to 10%. It's quite meaningful. That translates to about 1 to 2% ROE reduction for the average bank. So if you say, look, we are now in a dynamic where over time, there's going to be compression of overall profit pools. That's number one. Number two, the gain COE here dynamics is one that over time, extra profitability will be competed out. And the combination of the two basically imply, hey, moving quickly is advisable and could be advantageous.
It's a great piece of advice. I would also urge people to go back and look at the full report because there is a lot of great data in there that we're not able to get at here. Speaking of that, what were some of the other big trends or findings beyond the AI stuff?
The tagline, for the report this year was that precision over heft. Okay. We'll try to understand the impact of scale measured by number of people, size of the bank by assets, and say, look, are banks that are bigger necessarily more efficient, higher returns to shareholders, perform better? And what we found is actually that in some places, certainly like in the US, that's not the case. Like scale does not correlate to better performance. And this is where we say, hey, heft might not be the key thing. And what we believe is that what matters even more is precision. So what does that mean? Just to make it simply, in the context of M&A, it's not necessarily how do I buy the biggest bank that I can afford to size up. It's how do I find opportunities to buy banks that are more complementary to me, that have talent that I need, that have maybe some technology stack that could be advantageous to me, right? So that's precision in the context of M&A. In the context of capital deployment, right? Like critical for banks, how do I become super precise and how do I categorize different loans? And how do I think about the right way to define those loans in order to optimize my risk-weighted assets? That's the precision there. In the context of customers, like really identifying the segments that you believe you could win with and tailoring your approach to how you reach to them, whether it's like through digital marketing or through your bankers, and tailoring the conversation almost on a one-to-one level. Like I'm going to have the conversation with Roberta differently than the conversation I'm going to have with Ido. So those are some illustration of what we mean by precision and why we think that matters more than heft.
And it makes perfect sense because we have all this data, right? I know that a lot of companies have data and they're not quite sure how to use it. That's really helpful. Listen, I've learned a lot in this conversation and I really appreciate you taking the time. Thank you for joining.
Thanks, Roberta, for having me. And thank you for our listeners. And I will say that you are much nicer than your agentic virtual interviewer that I practice with.
It's good to know that humanity still means
Exactly.
something. I appreciate it, Ido.
Thanks so much for listening to the McKinsey podcast. I'm Lucia Rahili.
And I'm Roberta Fusaro.
Find us on McKinsey.com. We'll have a transcript of this episode up shortly.
And download the McKinsey Insights app where you can find this podcast and other helpful content updated daily.
If you enjoyed the show, we'd love for you to leave a rating and a review.
We'll see you next time.